What if you could learn the same principles that made Warren Buffett one of the wealthiest individuals in the world? Imagine unlocking the strategies behind his incredible fortune and applying them to your own financial journey. In this video, we're going to unveil Buffett's timeless investment secrets, principles that are simple yet powerful enough to change your financial future. By the end of this video, you'll have actionable steps to start thinking and investing like one of the greatest minds in finance. Start with the right mindset. Warren Buffett often says, investing is simple but not easy. This means that while the principles are straightforward, the discipline to stick with them requires the right mindset. Buffett focuses on long-term growth rather than short-term gains. His philosophy emphasizes patience, consistency, and rationality, qualities that are critical to building wealth through investing. Start by adopting a mindset that prioritizes steady progress over quick wins. Developing the right mindset also involves detaching yourself from the noise of daily stock market fluctuations. Buffett advises tuning out the short-term distractions and focusing on the long-term potential of your investments. Ask yourself, am I building wealth for the next quarter or the next decade? Aligning your goals with a long-term perspective is the first step to thinking like Buffett. Invest in what you understand. One of Buffett's golden rules is to invest only in businesses and industries you understand. He famously avoids tech companies he doesn't fully grasp, instead focusing on sectors like consumer goods, banking, and insurance, where he has deep knowledge. The takeaway: don't invest in something just because it's trendy. Take the time to research and understand the fundamentals of the assets you're considering. Buffett calls this staying within your circle of competence. Your circle of competence includes industries or businesses where you have a solid understanding. By sticking to what you know, you significantly reduce the risk of making poor investment decisions. If you don't understand how a company makes money or its competitive advantage, think twice before investing. Value investing. Buy undervalued assets. Buffett is a master of value investing, the strategy of identifying companies that are undervalued by the market. He looks for businesses with strong fundamentals, like consistent earnings, competitive advantages, and solid management, but whose stock prices don't reflect their true worth. By buying these undervalued assets, he positions himself for significant long-term gains. Start by learning how to analyze a company's financial statements and assess its intrinsic value. One of Buffett's favorite tools for assessing a company is the price-to-earnings P/E ratio. This metric helps investors determine whether a stock is overvalued or undervalued. However, Buffett doesn't rely solely on metrics. He looks at the company's overall story, its leadership, and its potential for sustainable growth. Value investing is as much about understanding the business as it is about analyzing numbers. The power of compounding. Buffett often credits compound interest as one of the most powerful forces behind his success. By reinvesting earnings and allowing them to grow over time, even small investments can snowball into substantial wealth. The earlier you start investing, the more time compounding has to work its magic. Remember, it's not about timing the market, but about time in the market. Let's break this down with an example. If you invest $1,000 at an annual return of 8%, it will grow to over $10,000 in 30 years without adding another dollar. Compounding works best when you give it time, so the sooner you start, the greater the impact. Focus on quality, not quantity. Another key lesson from Buffett is to focus on quality investments rather than diversifying excessively. While diversification can reduce risk, Buffett believes it's better to invest heavily in a few well-researched opportunities. This approach allows you to maximize returns on your best ideas rather than spreading yourself too thin. As he puts it, wide diversification is only required when investors do not understand what they are doing. For Buffett, quality means investing in businesses with durable competitive advantages, companies that can maintain their profitability over decades. Look for businesses with strong brand recognition, loyal customers, and a history of consistent earnings. These are the types of investments that can weather economic downturns and deliver steady returns. Keep emotions in check. One of Buffett's greatest strengths is his ability to remain calm and rational, even during market downturns. He doesn't panic when prices drop. Instead, he sees it as an opportunity to buy more of his favorite investments at a discount. Emotional discipline is critical to successful investing. Avoid making impulsive decisions based on fear or greed, and stick to your long-term strategy. Buffett often says, "Be fearful when others are greedy and greedy when others are fearful." This principle emphasizes the importance of staying contrarian during market extremes. When others are panic selling, look for opportunities to buy high-quality assets at a discount. Stick to your circle of competence. Buffett often talks about the importance of staying within your circle of competence. This means focusing on areas where you have expertise or can develop a deep understanding. By staying within your circle, you reduce the risk of making poor investment decisions. As Buffett says, you don't have to be an expert on everything, but you do have to know your limits. Your circle of competence isn't static. It can grow over time. By continuously learning and expanding your knowledge, you can increase the range of opportunities available to you. But remember, it's better to be deeply knowledgeable in a few areas than to have a superficial understanding of many. Learn from mistakes. Even Warren Buffett makes mistakes, but what sets him apart is his ability to learn from them. He openly discusses his errors and uses them as opportunities for growth. As an investor, it's essential to reflect on your own mistakes, identify what went wrong, and adjust your approach moving forward. Remember, every setback is a chance to improve. Buffett often reviews his investments to identify patterns or missed opportunities. Consider keeping an investment journal where you record your decisions, the rationale behind them, and the outcomes. This habit can provide valuable insights over time. Invest for the long term. Buffett's favorite holding period is forever. He invests in companies he believes will perform well for decades, not just years. This long-term perspective allows him to ride out short-term market fluctuations and benefit from sustained growth. When you invest, think about the future potential of your assets rather than their immediate performance. Long-term investing also means resisting the temptation to constantly trade. Frequent buying and selling can rack up transaction fees and taxes, eating into your returns. Instead, focus on building a portfolio of high-quality investments that you're confident holding for years. A final thought. Warren Buffett's investment strategy is rooted in simplicity, discipline, and patience. By following his principles, investing in what you understand, focusing on value, and thinking long-term, you can build a solid foundation for your own financial success. If you'd like to dive deeper into building wealth through practical strategies, check out our video, How to Become Wealthy at a Young Age, linked on the screen now. It's packed with actionable tips that complement what you've learned here. What's one Buffett principle you're ready to adopt today? Let us know in the comments below. And if you found this video helpful, don't forget to like, subscribe, and share it with someone who could benefit from this message. Thanks for watching, and we'll see you in the next video.